1. In the initial deal structuring stage, crucial decisions need to be made regarding the terms and conditions of the security token. Deal structuring is an integral part of any securities offering, irrespective of the technology employed. Tokenization is not meant to be a way of avoiding compliance with applicable legal and regulatory requirements. Rather, the use of technology is intended to fundamentally improve operational processes to enable innovative financial solutions. The stages in the diagram shaded in blue are where technology can bring significant benefits. A2. The digitization stage is where information traditionally stored in paper or document form is uploaded to the blockchain encoded in smart contracts, and security tokens are issued. A3. Primary distribution is the process where tokens are distributed to investors in exchange for investment capital, and the investor's information is recorded on the digital ROM. A4. Post-tokenization management involves corporate action management processes including dividend distribution and shareholder voting, many of which can be automated by smart contracts coded on the token. Post-tokenization management will continue throughout the life of the token until maturity or redemption. A5. The final stage, and where the value of tokenization in enhancing liquidity is realized, is secondary trading. This is where a token holder can trade tokens with another investor in an over-the-counter arrangement or on an exchange. Phase 1. Deal structuring. AAA security tokens are typically issued by an entity, corporate or an individual, and provide the token holder specified rights such as ownership, repayment of a specific sum of money, or entitlement to a share in future profits. The form and structure of a tokenized security is crucial in determining the rights and obligations that the investor has in the underlying asset as well as ultimately what form of return they will receive. It will also be the starting point in analyzing how gains and losses on the tokenized security should be taxed. Furthermore, tokenization could affect the valuation process, which may, in turn, affect the trading price of the security token. As tokenization is still a relatively new space, analysis of the above issues must be undertaken on a case-by-case basis. However, this may well change in the future as transaction data of tokenized securities accumulates for institutional analysis. A fractional ownership allows the interests in an asset to be shared among a wide pool of investors, and the programmable nature of security tokens technically enables unlimited share classes and widely customizable fee structures at a low operational cost. With these new options available, issuers will benefit from clearly identifying the target investor base, including levels of investment capital commitment and anticipated demand for liquidity. Value from savings of administrative costs. The tokenization process can significantly reduce the administrative costs of owning an asset. Using built-in smart contracts, periodic administrative actions such as quarterly reporting or income distribution can also be automated, further reducing administrative and compliance costs. Assets with long life and frequent administrative activities, such as real estate assets or funds, are particularly well placed to benefit from the cost savings offered by tokenization. A value from liquidity premium. A liquidity is the ability of an asset to be readily converted into cash without suffering significant discount. The stock of a publicly traded company such as Alibaba or Apple is the perfect example of a liquid financial asset. An investor can buy and sell the stock of the company fairly easily without much delay or incurring high commission costs. When an asset is not liquid, an investor might not be able to buy or sell the asset right away, and therefore face uncertainty in price fluctuation between the time an investor decides to buy and the time the transaction closes. Transaction cost might also be substantial due to the illiquidity of the asset. Large commercial properties are good examples of illiquid assets, as each property is unique, lack of standardization, and requires large upfront investment. The transaction period for such investments are long, and once invested the owner tends to hold the asset for a prolonged period due to high transaction costs. A typical timeline from finding a property to closing the transaction can be anywhere from 6 months to 2 years, and the transaction fees range from 1% to 3% of the asset value. A publicly traded real estate investment trusts, REITs, are one option of liquid real estate investments. However, the process to offer and list a REIT in most of the established exchanges in the world is time-consuming and generally takes more than 2 years of planning. It can also be expensive, with costs ranging from 3% to 10% of the market value of the assets, which translates to costs of up to several $million. Using a REIT to provide liquid real estate investment is not a feasible option for owners of a single asset or a small portfolio of assets. In contrast, tokenization is ideal for owners of a single asset or a small portfolio of assets, due to the significant reduction of time and cost in offering investors the right to participate in fractional ownership and subsequent secondary trading. Phase 2. Digitization. Tokenization unlocks liquidity by enabling fractional ownership and lowering the barriers to entry for investment in illiquid assets. 2 core components of tokenization are blockchain technology and smart contracts. Blockchain technology helps to streamline processes by allowing separate stakeholders to have secure access to the same copy of data, which cannot be altered without validation from other stakeholders. The data central to tokenization is a digital ROM for the asset to be tokenized, which is uploaded to a blockchain as a complete record of ownership. A technology enables fractional ownership to be securely managed as a digital record, investor due diligence and compliance protocols to be automated, and transaction settlement to be completed digitally. The cumulative effect of these changes is to significantly reduce the time and economic costs associated with trading previously illiquid assets, which benefits asset owners and investors alike through unlocked liquidity. As regulatory regimes across the globe evolve to meet these technological developments, secondary market trading for tokenized assets will thrive.